Good afternoon, everyone. Patrick Ganley here, along with Angus. Angus, how are you today?
Good, thanks, Patrick.
Okay, we've got a interesting presentation for all the members. We welcome all members to the presentation today. Again, you have Patrick and Angus doing the macro webinar today. So a lot of you will know us as we've been doing this presentation for a while now, but there's a face to the name. Just get some housekeeping out of the way. Presentation is for general advice only. Any information or recommendations made in here is on general advice. Before acting on any of the information, recommendations, or content, please consult your financial advisor before doing so. And please be reminded that past performance is no indication of future performance. During the presentation, you'll have the opportunity to ask any questions. We'll endeavor to get through all the questions that come through. Follow the orange arrow. You can type the questions into the screen during this presentation. If you can't hear us or having any technical issues, please feel free to call us 1-300-88-1177, and someone in the office will help you. So we'll start off market update. Angus, it's been quite an interesting week in the markets, and we've seen a lot of different things happening, and I thought we'd start off with this chart, the SPX showing signs of fatigue. So maybe we can talk to the members a little bit about this.
Yes, look, I think we had that pressure, sort of coming through in September and October, where the S&P 500 went down and touched that sort of 4100 level, and then we've had this monumental rebound recovery rally throughout November, back up to that big resistance level at 4600. So look, I think the market is probably showing signs of fatigue. It is looking overbought. I think a lot of that Christmas rally that was that we were looking forward to, or anticipating a few months ago, I think a lot of that has actually now been priced in, and the market, is obviously now looking ahead directly towards March, when the Fed's going to start cutting rates. So a lot has actually been priced in. So it wouldn't surprise me if the lion's share of the Christmas rally is now behind us, and that we're going to see the S&P 500 consolidate, for the next sort of 4 to 8 weeks, as we head towards the next reporting season, which gets underway in January. Now, I think given that the markets are looking ahead to these rate cuts that the Fed are anticipated to begin doing in March, the economic data points are going to take on quite a sort of heightened sensitivity, I think, as we sort of head towards the end of the year. So the upcoming non-farm payrolls, which provides an insight and a window into how the US labor market's tracking, that's due out tomorrow, later tomorrow, and also how wage inflation and growth is going. These will take on a heightened sensitivity, and they'll either reaffirm the case that the Fed's going to be cutting in March, or they'll take away from that. And it's difficult to see the market, the S&P 500, breaking through that 4600 level this side of Christmas, I think, and making new highs or testing the record highs. So I think we're in for a period of consolidation, and if there is a pullback, we'll probably see potentially a 50% retracement of that November move back to around that sort of 4400 level.
Okay, and we saw the ADP job data showed more signs of a cooling U.S. job market. How did you read that?
Well, I think there's no question that the U.S. economy is slowing. This ultra tight monetary policy is beginning to slow the U.S. economy, and we're sort of seeing it coming through. We've known that the manufacturing PMI numbers have been weak for some time. I think we're now going to start to see a slowdown in growth, and GDP growth is going to come in at a lot lower than the September print, I think, for this quarter. And of course, it stands to reason that we're going to start to see a softening and an easing in the labour market. And of course, it was really sort of, wage growth, inflation that's been one of the key drivers. So of course, these are the things that the Fed want to see. And if the non-farm payrolls really undershoots and comes in well below expectations, that will galvanise the bulls who are looking to the Fed to be cutting interest rates quite aggressively from March next year. But if the non-farm payroll numbers come in and they're going down, indicating a softening in the labour market, but they're not going down rapidly, then that takes away from the case that the Fed will be cutting. So look, I think bottom line, heightened sensitivity to data points, because that's going to tie back to just when we can expect those rate cuts from the Fed. Is it going to be a March story? Is it going to be a July story? Is it going to be a September story? And for now, the S&P 500, I think, is in correction mode, and we're going to see some consolidation over the next sort of 4 to 8 weeks.
Okay, and as we move on, I know you wrote a little bit about crude oil today in your daily note to the members, and we can point to this chart, oil breaking down below support, and I know you spoke about this pointing to falling inflation at this point in time.
Yeah, so look, just in terms of the price action with WTI crude, that break of support was pretty bearish. I didn't think it would go much below 75, but it has, and the break down to below $70 has been quite abrupt. Trying to figure out what OPEC are doing, and what they say and what they do can sometimes be two different things. But it seems to me like there's a bit of disarray within the cartel, and the fact that OPEC's market share has been declining, where the United States share of production's been going up. We saw record production, I think it was for September or October, out of the United States. Their daily production rate went above 13 million barrels, which is a record. So, I think, look, near term for the oil market, best case scenario, oil consolidates in a range, $65 to $70, unless Saudi Arabia try to flood the global market with supply to bring the price down even further, to squeeze out the higher cost producers, regain market share, with a view to looking to tighten up the market next year. But those production cuts that were announced and extended through to January next year clearly are not having any impact. I don't think this is so much a story about falling demand. I think this is really waning demand. I think this is really more about burgeoning supply, and the fact that the United States has really been able to ramp up their output, which I think has surprised a few economists. It certainly surprised me. Anyway, there is a silver lining to this, and whilst it's not great for the energy stocks, which have underperformed in the last 3 or 4 weeks. What this is going to mean, though, is downward pressure on the CPI. Inflation's going to come off. Petrol prices should come down, and this is going to ease up on inflation and confirm that falling downward trend in inflation. So, if anything, this adds to the narrative that the Fed moves sooner rather than later with rate cuts. Personally, I think they won't go early until there are real signs that the labour market is rolling over and has turned. And to me, that means that the unemployment rate in the States needs to have a 4 handle on it. So, but this is good news for the falling inflation narrative, and it means that I think the Fed will be cutting rates, will potentially be cutting rates sooner rather than later. The big question is whether it's, is it going to be March or is it going to be the June quarter?
Okay, if we move on to the 2-year bond yield, deflationary forces reasserting, and I know you just touched a little bit on that in relation to the fact that it looks like inflation is starting to fall and the US economy is looking like it's starting to slow. Maybe we could just talk about this chart for a second.
Yeah, this chart is quite significant, I think. The 2-year bond yield breaking down below that sort of primary uptrend that's been in place. And, all things being equal, with oil prices coming off and inflation receding, and probably more importantly, the unemployment rate going up, which takes pressure off wage inflation. This is going to add to the deflationary narrative, and basically make it almost a certainty that the Fed will be cutting next year. The question is when and by how much. But in terms of the technical setup for the 2-year bond yield, I think we're going to see this the yield fall back to 3.9%, and possibly, as the Fed moves through the cutting cycle, we could see the 2-year bond yield down to 3%. Now, before everyone sort of jumps up and down and says, "Oh, Angus is bullish on bonds," I'm bullish on bonds near term. That's a near term, medium term view. And I think these big breakout levels are going to hold the bond markets. I don't think yields are going to go below those historic breakout points. So for the 2-year, that historic breakout level was 3%. So I think that's a decent target for where the 2-year could go next year. And that implies, Pat, about 150 basis points, or thereabouts, 120 to 150 basis points of easing, by the Federal Reserve throughout the next part of the cycle.
So, and I know we've been talking about the interest rates. We're talking about the Fed looking to start cutting rates sometime late first quarter, maybe second quarter 2024. We saw the RBA this week here in Australia keep rates on hold. How did you read that, and what do you think the RBA is going to do as we head into 2024?
I think that's a great question, and it really cuts to the chase in terms of what's been going on with central bank tightening. As we know, the RBA didn't tighten as much as the Fed. The Fed pushed the Fed funds rate all the way to 5.25%, 5.5%. We're currently at 4.35%. There's quite a big gap. It's a similar story for other central banks around the world. The ECB for one, the UK for another. Now, why is that? Well, one explanation is that, US borrowers were a lot more insulated in the US market, simply because it's a much more sophisticated mortgage market where you could borrow money for 30 years, you could lock in your mortgage at 2%, and, sit back and watch the mortgage rate blow out to 6 or 7%, and you've got your mortgage rate fixed at 2%. So, that explains why the sales volumes of houses and apartments collapsed in America this year and last year, and that, no one was selling. Why would you sell when you're going to go and buy another property and, roll your mortgage over it from 2% to 6%? So, I think that is the explanation for why the Fed had to tighten so aggressively to 5.5%, whereas we didn't have to tighten as much to get the same impact, the same policy impact at 4.35% in Australia. Is just as effective as the Fed hiking to 5.25%, 5.5%. So it stands to reason, just as the Fed led the world in raising rates and hiked further than most other central banks, it stands to reason that they'll also lead the world in terms of cutting, and they'll bring rates down probably faster than most of the other central banks. Anyway, that's my view for 2024.
Okay, so we'll move on to this chart. Bond yields undermining the dollar. I know you and I have spoken quite a bit about the U.S. dollar over the last few weeks and months, and your view is that the US dollar probably will start to come off and go lower. And maybe we could just have a look at this chart and you can just make some comments on this for us.
Yeah, I think, look, just as the US dollar index got up to 115, that big peak, when the Fed were hiking faster than the other central banks, they were miles out in front, and a lot more aggressive. Those interest rate differentials favored the US dollar. They blew out the gap between the United States and the rest of the world, with US rates a lot higher. That was a huge tailwind for the greenback. But now we're beginning to see that unwind. And, we've got this sort of deflationary story sort of coming through for now. We've got oil prices lower, and, we've got markets having quite high conviction that the Fed's going to be cutting. UBS believes that the Fed will cut 275 basis points in this cycle. That's not my view, but that's what they believe. The average, probably the consensus view, is 120 to 150 basis points. What this means basically is that, when the Fed does go into easing mode, they're probably going to do it more aggressively and bring rates down faster than most other central banks, which will narrow those interest rate differentials. I think that's going to, add to our case that the US dollar goes down next year. So that's one of our big calls, the US dollar coming off, with the Fed pulling rates down faster than other central banks.
And I think that ties in a lot with quite a bit of the macro views and strategy for 2024, with the falling US dollar, gold prices going up, and commodities in general. So we can move on to this chart. Gold sustaining the breakout. We saw gold bounce around quite a bit this week, and maybe we could just touch on this gold chart for a second.
Yeah, so gold broke out to a new record high, and I guess there's a lot of traders looking at it saying, is this going to be another occasion, like the fourth occasion since 2020, when gold's made a new record high but has been unable to follow through? So far, look, I think the technical setup is highly favorable. We've had 4 goes at record highs, and I think this time gold's going to stick, and it's going to hold above the breakout level and consolidate, and then start to move higher when that US dollar starts coming off. Markets are never linear. Moves, trends are never linear. There's always potholes and hiccups along the way. And whether gold sort of races away to new highs. I mean, a lot of it's going to come down to the direction of the US dollar. It's as simple as that over the next 3 to 6 months. And if we're right that inflation's coming down quite quickly, those bond yields continue to come off, and we're going to see the dollar lower, and I think we'll see gold and silver and the other precious metals quite a bit higher, looking at over 3 to 6 months. So I think the technical setup for gold is pretty bullish, and I think we're going to see follow through price action on the top side in coming months.
And I think you're well positioned in the funds and in the wealth management products that we have with gold and commodities. And I know we've got quite a few recommendations as well in the research reports relating to gold. And we saw some interesting news this week with one of the stocks that we have liked for a long time, and we continue to like Evolution Mining this week. Angus, we saw a bit of corporate action there. What was your take on Evolution this week with the news on a takeover?
Yeah, so Evolution are buying they're buying a new asset. It's an old, well-established mine and near Cowell down in New South Wales. It's copper gold, and this will add to Evolution's gold output, but also lift their copper output by 50%. When the transaction completes. And I think, look, generally speaking, I thought it was quite a good deal, a really good deal. I think the management team were quite timely in raising money at 380 a share to fund it. The reaction was a bit disappointing, but we haven't really seen Evolution follow through today on the downside. And I think ultimately at the end of the day, this looks to be accretive for Evolution. And 30% of the revenues are now going to come from copper. I think this is quite an interesting one because copper is tied to the renewables, and silver. Actually, silver and copper are used quite extensively in solar panels, essentially the next generation of solar panels which are coming out. And there's going to be a natural shortage of copper anyway, looking out over the next 5 to 10 years. So yeah, I think this sort of sets Evolution up. You had sort of a mixed reaction, really. I mean, the market voted with its feet. I mean, the stock was always going to come off, given there was a placement at 380. Yeah, my view is that there's going to be some opportunities, and that there's potential that they'll be able to extend the mine life. And that's probably what the market was worried about yesterday. Just saw an 8-year mine life, despite the fact that it's EPS accretive and sort of focused on that. But there will be potential to extend it.
And a key part of that acquisition is copper. And I know you think a breakout is looming in the copper price due to the shortage of supply. So that should bode well.
I should have actually put a chart of copper in there. I had that in my note this morning, but the copper price is looking quite interesting. It's coiling up and converging within a narrowing triangle range, and I think a breakout's coming. If it's a downside break, the world's slowing down and the economy rapidly cooling, people worried about manufacturing, etc. next year, and it's a downside break. Well, I don't think the downside risk is that much, and our base case would actually be for a topside break as that US dollar comes off next year. So I think that this will all prove to be quite timely for Evolution.
Okay, and if we stay in the commodities and we move to silver, correcting below resistance, but the case for a breakout next year is growing. And I know that's a common theme that you have going into 2024 is gold, silver, and commodities in general. Maybe we could just talk a little bit about this silver chart here.
Look, I think, silver, which has a number of industrial applications, I think the bull case for silver is growing by the day. We can see silver coiling up below this topside resistance level. It's not quite ready to go, but it's looking, more and more bullish, and it's just sort of waiting for the right sort of catalyst. Whether it's going to be demand led or a dollar weakness thing, I don't know, but it might end up being a combination. But a breakout looks to be coming nevertheless. I think the silver stocks themselves, Patrick, are quite interesting. Their valuations are pretty low. They're pretty much out of favor, and a lot of the silver miners are actually inflecting higher now and putting, we've seen the lows and they're working their way up. So yeah, I think, if we're right on silver and it does break out to the top side next year, we'll see quite a decent re-rating in the silver miners.
And how would you play silver at the moment? Would you be in the stocks or potentially in an ETF?
Look, we like the ETFs because then you're getting a basket. You can get away from specific company risk. You know, the one that we have in our portfolios is the Global X Silver Miners ETF, SIL, and it trades on the US exchange. I also like Kerr Mining, you know, which is trading at around $3, and where they're ramping up silver production next year, and you know, there's a lot of upside risk and potential upside in that stock if the silver price breaks out, you know, much above $25 an ounce.
Okay, and at this point in time, I'd probably just go with a couple questions. We're getting a question on evolution. Obviously, we still like evolution. We still have a buy recommendation on evolution. You wouldn't be selling evolution at this point in time, would you, Angus? You'd be keeping it in the portfolio, correct?
Yeah, we're holders of evolution, you know, with the view that copper and gold prices are going to go high next year.
Okay, I thought we'd talk a little bit about next week. I know you're preparing your Baker's Dozen, top predictions for 2024, which I believe we'll be putting out to the members in your daily notes sometime late next week. Is that still the plan at this point in time?
Yeah, that's right. We do our review. What we got right, what we got wrong. That comes out on Thursday, and then Friday, which marks my last publishing day for 2023, will be my roadmap, strategic outlook, core predictions for next year. And I think it's probably fair to assume, Pat, there's no spoiler alerts on this front, but I think it's probably going to be no surprise to anyone that you know, we're pretty bearish on the US dollar.
Okay, and we've an election year. We got a big year in the U.S. with politics as well. So be quite
There's
interesting to see how that all plays out.
There's a couple of surprising ones on the US election, given that it's got, you know, there's so many implications for financial markets. And in 2016, you know, you recall we first called the Republican nomination would be won by Donald Trump, and then the election would be won by Donald Trump, and that all played out. The prediction for next year is going to be a little bit surprising. I think
Okay.
our members will find this one quite interesting.
Okay, well, we'll wait to see that for next week, which will come out on Friday. So we do alert members to have a look at that note as it comes out later next week.
I'll give you a clue. Well, I'll give you a hint. It's not the former president, President Trump, and it's not the incumbent president.
Okay.
So
that's a bit of a curveball.
Yeah, you'll have to wait till Friday.
Okay. Can you just go over that silver ETF again? I've got a couple members asking just the exact name. I think they missed the name of the ETF that you like.
Yeah, it's the Global X Silver Miners Exchange Traded Fund, and it trades on the New York Stock Exchange, and the ticker code is CDE.
Okay, thank you for that. And
Sorry,
question
not CDE. That's Kerr Mining. It's SIL.
Okay, SIL is the code for the ETF silver for those members that are asking. I do always like to ask you as we wrap up the webinar today, obviously, are there any key things that you're focused in on or looking for? I know you talk about some key data points coming out as you head into next week. Are there any key things you're keeping your eye on?
We've taken a position in the crypto miners, not crypto, but crypto mining, I think there's an opportunity there. Can't really go into it in too much detail because we're still building our position in both of our funds. But I think, if the precious metals have a good year next year, it stands to reason that the Bitcoin will probably have quite a good year as well. And there's quite a bit of upside to be had in some of those Bitcoin mining stocks. I think the data points are going to be key because, that's going to influence the bond market, whether the rate cuts are happening in second, first, third quarter next year, and how deep they'll be. So I think that's going to be, crucial. And of course, the direction of the US dollar. We've talked today on the podcast, on the webinar about, the economic data and the direction of US rate cuts being decisive. But, looking out next year, I think this de-dollarization trend that's underway in the world has got real legs in terms of being disruptive to the greenback. And, I think the US dollar could fall perhaps further than probably what a lot of the investment banks and strategists are sort of saying at the moment. I mean, it was only a month or two ago that it was hard to find an investment bank which had a bearish view on the greenback.
Okay, and with the managed accounts that we operate here at Fat Profits, with the two listed funds, the ETF and the LIC, how are your cash positions? Are you still skewed with quite a bit of cash there waiting for buying opportunities, or are you looking to move back into the market with some of that cash?
We're sort of carrying about 6 to 8%, probably about 6% cash at the moment. We have put a little bit more into the market, but pretty much focusing on our core themes. The US dollar going down, still like the Japanese stock market. Although I think you've got to be careful with the Japanese yen, it could rise quite a bit next year, which will put some of those Japanese exporters under a bit of pressure. But still very much like the Japanese story. We still like this whole theme about renewables and energy, and it's interesting how silver and copper are starting to become part of that renewables story. They're going to key metals that are used in making the new generation of solar panels, which the world's going to need a lot of. I think uranium's got further upside, so we're still there, and all those thematics. And I think we've only got a beachhead position in China in terms of Hong Kong listed Chinese companies, but and the price action's been dreadful, but so has the capitulation that we've seen over there has been, extraordinary. We've seen so much selling. So I think, at some point that market is going to turn. And I think emerging markets generally next year, Pat, do a lot better because of that US dollar coming down. That strong US dollar has been a headwind, certainly a huge headwind for 2022 and for much of this year, but that we might find that dynamic reverses next year.
And maybe we'll just touch on China. How do you think things are going to pan out for China in 2024? Do you think they're going to stimulate?
I think the government have got no choice, and I think the meeting where Xi flew to San Francisco to meet Biden a few weeks ago, I thought that was quite revealing, and it really says to me that President Xi and the Politburo in China really are having to prioritize the resuscitation of their economy. And so I think that was symbolic, but it was significant. I don't think there's going to be too many geopolitical tensions over Taiwan anytime soon between China and the US. I think China's focus now is to get their economy back on track. The blowout in the property market was a fairly debilitating blow. George Soros warned about this back in 22. He said it could push the world into a recession. I don't think that's going to happen because the Chinese government are onto it and they're just pulling too many levers. But what they don't want to do is fire a big fiscal bazooka and then blow the housing market up again and have another bubble coming through. They're really trying to sort of get on top of it and deflate it. So so I think probably another tough year for the housing market. And I think that the Chinese government will continue to implement measures to try and shore all of this up. But the stock market, as we know, typically bottoms before the economy. And I'm looking for an important low, probably sometime in the next 2 to 3 months in China, Hong Kong stocks. I mean, they're pretty cheap now. The bears would say, well, earnings are rolling over, and they are. Earnings are coming off in China, but some of the selected exposures, some of the consumer-facing stocks, some of the internet-based stocks. We own things like Tencent Music, which are doing quite well. They're all getting quite good top-line growth. So I think there's an important inflection point coming there, and that's something to be watched.
Okay. Well, Angus, thanks for your time today. And we'd like to thank all the members for tuning in and listening. We hope you got some value out of today's presentation. And as always, we will be sending a recording out to members if they would like to listen to this again. If anybody has any questions, members have questions, please feel free to call us 1-300-88-1177. And we'll say bye for now, and I hope everybody has a wonderful day and a nice weekend. Thanks, Angus.
Thanks, Patrick. And I just want to say thanks to our members, thanks to our shareholders and our investors for supporting us this year. It's been wonderful to have that support. It hasn't been the easiest of years. We've seen even the top-rated strategists on Wall Street be tripped up quite badly this year with the big rally. So I just want to thank everyone, and this will probably be our last webinar for the year, I think, Patrick. And given that we're doing the Baker's Dozen and the Tribe Has Spoken review Thursday and Friday next week, and I look forward to joining you again when we resume the webinars in January of next year. Bye for now.
Okay, bye for now. Thank you.